Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 14th of November, and we have oil markets trading a little bit stronger this morning after sort of opening the week in Asia yesterday with the sort of softer, more downward outlook. There was recovery through the day, and ultimately there's a bit of momentum back in this market, supposedly on the back of OPEC report indicating a stronger demand expectation in the fourth quarter. It sounds potentially like talking up your own book, perhaps, but nonetheless, that's where the market's. I mean, then it's a market looking for some direction, and where maybe all news was seen as bearish news, maybe we'll get a bit of momentum where all news is seen as bullish. Let's kick off this morning with Neil Atkinson, former head of oil markets division at the IEA. Your thoughts, Neil, on the direction of travel. This market was always forecast to be very tight in the fourth quarter. Hasn't really transpired, but nonetheless, OPEC report yesterday somewhat bullish.
Well, of course, forecasts can be wrong. And it looks as if the forecast that we'd had for a long time of acute tightness in the fourth quarter has turned out to be inaccurate, as much because supply has been higher than people had anticipated, as much as strength of demand. OPEC came out with their monthly report yesterday, as you suggested. Are they talking their book? Possibly so. At 2.5 hours from now, the IEA will come out with its monthly oil market report, and we may get a slightly different picture. We may see an easing of their forecast for demand growth. I don't know. I have no inside information. So at the moment, we're in a sort of betwixt and between, where people are perhaps coming to terms with the fact that the tightness that was widely anticipated is not there, and we know we're now looking into the early part of 2024 to see if the seasonal weakness in the early part of the year, which we always get, how extensive that seasonal weakness might be. And of course, in between times, in where are we, about 2 weeks' time from now, something like that, we've got the meeting of OPEC ministers to absorb as well. So we're sort of up a bit, down a bit, and not exactly not finding direction, but there's a lot of contradictory thoughts out there.
Clyde Russell, Asia Commodities and Energy columnist, Thomson Reuters. Clyde, good morning or good afternoon, or maybe even good evening in Australia. Not quite. Good afternoon, I think we'll do it. But your thoughts on where demand is at. China, we had our regular commentator on yesterday, Victor, indicating that the outlook for demand in China is softening further. Your thoughts on where Asia and China in particular may be from the point of view of the health of this market?
Well, I think what's increasingly clear is that Asian demand is sort of bumping along without really growing much, without really shrinking much. I think you've seen the last sort of 5-6 months, certainly in the second half of this year, that it's eased back a little bit, for the region as a whole. And that's largely because China has sort of eased back on buying or importing crude oil from the high rates that it did at the beginning of the year. So yes, the narrative of a strong fourth quarter is yet to show up in the data that we've been seeing. What we are seeing is not a collapse in demand by any means, but not that sort of strong growth that's going to get to those sort of forecasts of world growth of 2.4 million barrels a day this year. That doesn't appear to be happening. I think the other thing, and I know I've mentioned this before, but I'll bang on about it again, is there's quite a large difference potentially between Chinese domestic consumption and their imports. They have vast inventories of oil and products built up. Even if they do get a demand surge, and there was some suggestion from PetroChina that might actually happen in the fourth quarter, but even if they do that, that doesn't necessarily translate into higher imports, either currently or in the first quarter, because they can just simply run down the stockpiles, which they bought at a very much more favorable price than what they have to pay now to import new oil.
Let's welcome Ali Riami from Oman. It's great to have you back at the table, Ali. Your thoughts looking at the situation facing OPEC Plus as they go into their meeting in 2 weeks' time. It's not a great time to be sort of gathering. I mean, putting aside the geopolitical backdrop, obviously a very significant moment, but the OPEC Plus ministers will be meeting in what looks like a softening market at a time when they have to embrace increased quotas for certain producers going into the new year. How do you see they take on that challenge with growing quotas but softening market?
Well, it's going to be challenging this time. And good morning, first, Sean, and always nice to be with you.
Thank you, sir.
I think you're right. The timing this time it's a bit odd to have this meeting, but this is an ordinary September meeting with OPEC. We do have this normally happens in October, in
November.
End of November and the beginning of December to prepare for next year's quotas and also to start talking about seeing the supply and demand forecast for next year and so on and so forth. So timing, it's always been there, but this time the situation is a bit different. We have a lot of geopolitical issues to discuss, and also we have the voluntary cuts that need to be discussed. We need to also to cater for those members that they have requested to increase their quotas, and so there will be a lot to discuss. But more important is that this time, are they going to discuss about continuing cuts from the countries or from the OPEC Plus, or is it going to be a status quo and nothing will change? Russia and Saudi Arabia, they will continue their cuts for next year. This kind of discussion, I think, it will be a subject of the agenda.
You would think that the least Saudi Arabia would want to see by the other members is compliance with their own quotas before they voluntarily carry the bucket for everybody else.
This is an ongoing issue. I mean, since the beginning of OPEC Plus, there are countries that are not complying. Either they are cutting more or less for several reasons, either technically or they don't comply because for their own budget reasons and so on and so forth. So the issue of complying is difficult to control since the beginning. But I think the situation now, and the hints already started, that maybe the Saudi Arabia and Russia, at least, they will continue having the cuts for at least for the coming first quarter of next year. The Royal Prince Abdulaziz bin Salman, he already started saying that the market is strong, but the speculators these are the ones driving the market and so on and so forth. So there is like an indications already there that maybe Saudi Arabia will decide to continue the voluntary cut at least for the first quarter, considering that the economy, the world economy, especially China and some other countries in Asia, is not really showing some indications of growth or any healthy conditions there at the moment, at least. So I think we will see like a continuation of this cuts, and also the extra cuts from Saudi Arabia and Russia for the coming at least the first quarter of next year.
Neil, we've got increasing voices in the last few days and maybe week or so around, what had been a fairly quiet sanctions enforcement around the violations or perceived violations of those who were ignoring the price cap and other aspects. This EU talking about another round of sanctions on Russia and so forth. Your thoughts on the meaning of that? Does it have relevance for the market that the sort of the sanctions policing department has woken up from their slumber?
Well, I'm not even sure there actually is a sanctions compliance department. If there is, then as you suggest, they've obviously spent most of the summer on holiday, and now gone into winter hibernation. Because what seems to be the case with the price cap is that clearly it's succeeded. Well, there were two objectives, weren't there? One was to keep oil flowing because we didn't want to see massive disruption to global oil supplies. But on the other hand, we wanted to make sure Russia didn't make very much money from it. And of course, that second part has failed. There's no doubt about it whatsoever. It's all very well the G7 countries imposing sanctions, which they're, of course, entitled to do. But other countries are entitled to take a different view. And we suggested earlier on, it may have been Clyde, I think, mentioned this, that China was stocking up earlier in the year when prices were relatively low. And of course, we've seen India increase its purchases of Russian oil massively from only 50,000 barrels a day before the invasion of Ukraine in 2021. And, 2 million barrels a day at certain points during last year and this year. So people see things very, very differently. And we've seen that Russia has managed to circumvent the sanctions by buying up old ships. We've seen that traders and other actors in the market have made alternative arrangements vis-a-vis insurance. So what we're seeing here, as with almost any sanctions regime you can think of over the many decades that we've seen them imposed in the oil market and in the wider economy, people find their way around sanctions. I mean, that's natural. And that has been the case with Russia. And yes, okay, there's been statements in the press in the last few days saying we need to tighten up, we need to toughen up. And you read in the press, in fact, just this morning, reading in the press of some trading outfits or some insurance outfits being sanctioned by individual governments. The UK has sanctioned somebody in Dubai in the last few days. Yeah, sure, fine. But if you really want to achieve your objective of keeping the oil flowing but depriving Russia of money, then you are going to have to tighten up sanctions very, very rigorously and actually set up some kind of police force, because there isn't a police force at the moment to speak of. So yeah, you've hit on a very important issue there, Sean. But I think we should say that earlier this year, when prices were rising and it became fashionable for people to talk about it's only a matter of time before we get to $100 a barrel, I think Western policymakers were actually probably secretly quite relieved that significant volumes of Russian oil were still in the market by whatever means. And now we're in a situation where they're going to try and tighten up the policing mechanism. We'll see how they manage to achieve that. I actually don't think they can, because the behavior of people outside of the G7 following their own economic self-interest, I believe that behavior will continue.
And all of
China and India.
And all of the tricks of the trade have been learnt now and bedded in.
Sure.
Clyde, the big meeting tomorrow, it doesn't happen very often. The Chinese and the American president meet. They're meeting, having a summit in San Francisco. Should we have expectations that this meeting will unfreeze this increasingly freezing relationship? Does it present a positive outlook for China next year with some relief from U.S. Sort of moves to confine it? Your thoughts on this summit and expectations?
Well, I must admit I fall into sort of cynical, skeptical camp. I would sort of say that these kind of meetings are always very carefully choreographed. You don't put two of the most powerful politicians in the world in the same room without having some idea of what's going to happen. Both sides will have said what they want, and there'll be a nice public statement. It will all sound really good, but will it actually change much on the ground? I don't think so. Is the US going to lift the Trump era tariffs that it put on China? Probably not. Are they going to relax exports of chips and things like that? I would be surprised. Is China going to suddenly pull back from keeping tensions relatively high in the South China Sea with its neighbors there? I doubt it. So, it won't really change much. That said, just the fact that they're prepared to talk is a positive sign. And there is some positives that you can take away from it. It's not all bad news, but it doesn't really alter this sort of trajectory that we're on of a cooling relationship and the idea that China is now not quite a Cold War enemy, but we're sort of no longer friends. I think that's probably, it's not going to change that, but it might just sort of ease things along for the time being.
Ali, given the great geopolitical trauma in the Middle East at the moment, with Israel's invasion of Gaza and now close to 12,000 Palestinians massacred, is there a hope, an opportunity here that these, as Clyde mentioned, two most powerful men in the world could bring that to the table, that they could find alignment to help bring this to an end? Your thoughts or expectations from the region for this meeting?
Unfortunately, I don't think so, because I think, the US and some European countries, together with Israel, I think they have already decided to continue to the end. Rightly so or wrong, I don't know, but the people in the ground, that these are the people that they are suffering out of this. But I don't think that this talks tomorrow between USA and China will bring any help or any support or any hope to solve this issue. The Israeli President Netanyahu said it very clearly 2 days ago that there is no way to stop the war at the moment, and they will continue until Hamas release some whatever people, and this is unfortunately that is a situation at the moment, and I don't think that there is any hope coming, or any hope. I can't see any hope in the air at the moment, unfortunately.
And given that, Ali, it does seem, while the stress is great on the region, both emotional and everything else, that this is being contained. The spread of this conflict it doesn't appear to be any appetite anywhere for it to spread.
I disagree with that. I think the longer it goes, I think it will create some more tension from different countries, and we have started seeing some nations like Lebanon, also the Hezbollah. He started already, escalating a little bit yesterday, and we don't know how that will go. But the longer you do this, the longer we see the massacres in Gaza, the more people are getting tired with this, and they're getting frustrated, and it is just pushing the governments to take actions. So the nations in the Islamic world, and also especially in the Arab world, they are frustrated, and they are really seeing this scenes in the news, and with the governments, they can't do anything. This is really frustrating them, and they will definitely, one time, if it is going to continue, then they will definitely push the governments to react. And I don't know how they will react, but
well, there was some strong. There was starting point, at least some fairly strong statements out of the Arab League meeting in Riyadh, and Riyadh hosted a number of meetings over the weekend, I think, to put some kind of baseline position together, and let's hope that it has some positive impact. Let's go to the survey question for this morning. Again, looking at the immediate events of tomorrow, this China-US summit. Will it deliver any breakthroughs for the growing Cold War relationship? Yes or no on that. Neil, we are moving into, obviously, deep into the fourth quarter. at the oil contracts now trading into the new year, and typically the first quarter, certainly in the northern hemisphere, is sort of a lower demand window and a weaker window for price. Does OPEC Plus, if they want to continue, as I was using the analogy last week, to keep the pole in this tent up, that they will have to do more in the first quarter, given it is the weaker window, that rolling over, for example, the unilateral voluntary cut just for 1 month at a time, they might need to do 3 or 6 months. Your thoughts on how to keep that sort of $80 to $90 pole in the tent up in this weaker first quarter?
Yeah, that's a very good question. I mean, the estimates for Q1 2024 suggest that global oil demand will be something between 1 million to 1.5 million barrels a day lower than it was in Q4. And that's, no great surprise, no great secret. There's always seasonal fall off. And of course, they will have taken that into account. And the OPEC ministers, as they're looking at their balances and they prepare for the meeting in Vienna. Obviously, to some extent, in some markets in the Northern Hemisphere, winter weather has an impact on oil demand because there is a significant heating oil market, particularly in the northeast of the United States and in other parts of Europe. So the weather will be a factor, as of course it is for gas markets. So, they'll have to take it, I think, step by step. One of the lessons that we've learned in recent years, particularly since the pandemic came in, is that it isn't necessary for this gargantuan OPEC circus that descends on Vienna a couple of times a year. It's not necessary for that to be convened for actions to be taken. They'll go ahead in late November with the planned meeting. I agree with Ali that the existing cuts and voluntary cuts, I think, will be extended, and I think they'll extend them, say, through the first quarter. But in the modern world, they have the ability to meet virtually, which they did many times during the pandemic and indeed since, and they can make adjustments as they see fit. So given that we're in a very delicate situation at the moment, I think they will play it very cautiously. They'll roll over and then they'll meet again if they need to in the early part of 2024.
Clyde, I was enjoying reading your op-ed today on the iron ore market in China, and just wanted to get your sense and insights on what it can tell us about China's outlook for the new year. You reported that the iron ore is defying the commodity gloom amid China property hopes. I mean, this sort of China property story has been anything but hopeful. Where is their hope, and what does it tell us about the rest of the macro outlook for China?
Well, I think with iron ore, what you're really seeing is that you are getting that hope idea that the turnaround in the Chinese property sector is imminent. Why are people thinking that? Well, the government seems to be taking more and, more importantly, bigger steps to prop things up. They've eased a whole lot of requirements on borrowing and buying restrictions and things like that. There's also signs, there's been a Reuters report that Ping An Insurance is going to buy Country Garden, which would take out, add a lot of confidence back in of these heavily indebted property developers, that is going to be sorted out. That still has to be confirmed. But you also, there are some fundamentals on the iron ore market as well. Namely, there's very low inventories for this time of year in China. They're the weakest they've been since 2016. So there's scope just to import to rebuild inventories. But what you're really seeing, the broader picture is there's now that confidence creeping back into the market that the first quarter is going to see recovery and more building, higher steel demand, and that's what iron ore is responding to. Whether this actually happens or not, still, it's still to be seen. But this is the sort of pattern that iron ore has been following this year.
And how does this marry with? I was going to say, sort of follow. How does this marry with the heavily indebted real estate developers segment in China who have missed some payments, etc.? How does the real estate recover or get out from under that when it's still this massive debt hangover?
Well, if the Ping An deal is true and is confirmed, but it's basically what it means is, the Chinese state is going to force state-controlled banks and insurance companies to basically bail out the developers. This is not terribly unusual. It happened in the Western world on occasions as well. So, but I think they've actually got to the point where they've realized they have to do something. So they have to clean up the balance sheets of a whole range of developers. These are huge companies. I mean, also something like property in China is roughly a quarter of the economy. It's massive. So they now appear to be taking seriously that they need to do something about this. So if this does happen, if these balance sheets are cleaned up and these companies can actually continue to operate, build new residencies, apartments, whatnot, then that confidence will come back in. And you'll start to see, the public respond to that, and they'll start buying things again. At least that's the hope. But it's probably a first quarter, second quarter story for next year rather than something right now. But as I say, the iron ore responds to this because the steel mills have to build up inventory of iron ore if they're going to actually produce more steel in the first quarter.
Let's get the last word for Ali and the survey result. Ali, just sort of finishing up where we started off this morning. So not a lot of optimism in this room regarding this summit tomorrow. But is there optimism regarding the OPEC report yesterday? And it's forecast for the fourth quarter. They had predicted a 3 million barrel a day supply deficit only a month or so, or 2 months ago, whenever that report came out from OPEC for the fourth quarter, i.e. it was going to be a massively tight market. Now they've come out and said that actually demand's stronger than has been thought. Where are these OPEC numbers? And as Neil mentioned, the IEA could be coming out in a few hours, and given past recent reports, be completely the opposite of OPEC.
Well, this shows you that these reports can be misleading sometimes, and they can print a different picture every time they issue. These are all estimates. We always know that after 2 or 3 months from now there will come another report to reflect the more reality and actual numbers. So this happens all the time. So I normally don't really take these reports on a very serious basis, because I know 1 month after that everything will change. And this is a result of what happens this time. So I think we'll continue having this kind of discussion every time the reports. Now it became more, I don't know, for some reason, now these reports are becoming more important to the media than used to be before. I mean, every time there will be interviews asking people, what do you think about OPEC
it starts to feel
report.
It's like they took a page out of the Goldman Sachs book, say the biggest number possible, $200 oil barrel, or, it's like, get the headline and let it have its news cycle. And
then you have yesterday, again, Sachs, they have revised their prices for next year to 98, I think, out of 150 before. So you can see that how this reports and how this people are really, sometimes they can go out of everybody's expectation, actually.
Even the guys who are paid the biggest bucks at Goldman Sachs still get it 50% off. So and probably still get a bonus, but that's the way of the world.
Brent crude oil, because I've always been trying to give the reality.
Yeah, well, that's probably what they don't want. They want the big sort of bullish number to it's a bit like the Chinese government. Set the target of 5% and everybody go for it. Brent crude oil, however, trading this morning at 82.75. I think notably and perhaps if nothing else, holding above 80, didn't break down into the 70s, which is probably some signal of positivity for the outlook going forward into the OPEC meeting, and the uncertainty of the OPEC meeting coming up will probably in itself create a slightly bullish tone, because as His Highness the Saudi Energy Minister has done in the past, likes to surprise the market, so probably will be staying on its toes over the coming 10 days going into that OPEC meeting. Thank you so much. Great to have you guys back at the table. The insights of the three gentlemen, Neil Atkinson in Paris, Clyde Russell in Australia, and of course, Ali Rayami sitting in the middle in Oman. Thank you very much for your insights today. And we'll catch you all very soon. Thank you.
Thank you.
All the
Bye.
best, guys. Bye-bye.
Bye-bye.